Hello and welcome to the lecture for part 2 of the week 4 lecture. In part 1 I talked about how to prepare financial statements. In this section I'll talk about how we analyze financial statements, which is equally important, I would say. So first of all, financial analysis, so looking at financial statements and trying to gain insights into the condition of the company and the performance of the company or whatever entity we're talking about, is done by both external parties and by internal parties or management. So external parties in the private sector, they're looking to determine whether or not they should invest more money in a company, or should they pull their investment? Are there worrying signs about future profitability or financial instability? So they're looking at the financial statements from that perspective. Lenders look at it for one reason and one reason only, to determine creditworthiness. Are we going to get paid back? That's their concern. So they're very focused on the company's ability to generate cash. I would say in governmental entities, the external parties are the citizens of the state or the country, that sort of thing, or other agencies that overview those agencies for which financial statements are prepared. Management goes much more in depth in this kind of financial analysis, and they do it for a variety of reasons. One is to uncover trends. So are there expenses that are rising faster than other expenses or faster than we might anticipate they would? To find out, are there issues that need to be resolved in the entity? We'll also look at it to ensure compliance with covenants. So many banks, when they issue loans to a company, they'll have certain criteria that the company needs to meet in order to keep getting their loan or to not have the loan immediately called. Those are called covenants. And it may be, we'll talk about this shortly, there may be a current ratio covenant that it has to be at least 2-to-1 or greater. So it behooves management to know where they're at on that before they provide those financial statements to the bank. Next, and this is probably the most important for me, is preparing for questions. So management is going to present their financial statements to a board of directors or some kind of outsider that's examining the financial statements, and they want to do analysis to determine what questions are likely to arise so that we can do the research and provide answers for those questions before we're asked. That's a key thing. And then lastly, we might find and correct errors in the financial statements. One way to analyze financial statements as an example is to compare to budget, right? We have a plan at the beginning of the year. This is what we think our revenues and expenses will be by month, and each month we should look at that. One error might be, hey, wait a minute, we budgeted $10,000 in utility expense and we're showing zero. Well, that might mean that somebody didn't enter the utility bill, or we didn't accrue for the utility bill when we closed month end. So we may have to go in and make corrections and reproduce the financial statements. So that's a really important task in analyzing financial statements, is looking for mistakes. Now, there are several different ways to do financial analysis. I'll talk about horizontal, vertical, and common size. I'll talk a little bit about liquidity, but in this class we won't cover solvency or profitability analysis, as I think it's probably a bit of a stretch in terms of applicability to your current jobs. So horizontal analysis is what it sounds like. We're looking across each line and seeing what the change was. So for an example, in this chart here, we're looking at sales in 2014 compared to 2013. In this case, sales went up by 296,500. That is a 24% increase. So the way we arrive at 24% is it's 296,500 divided by our base year, the year we're comparing against, which is 2013. So 296,500 divided by 1,234,000 is 24%. So we can make the claim that sales increased 24%. So how might somebody look at this financial statement, this comparative financial statement, and make some insights or find out where there might be a problem that requires kind of further digging or more research? Well, if I were looking at this, my concern would be a couple of items. One, cost of goods sold. It went up 27.2% while our sales went up 24%. That's not a good trend. If our cost of the products we're selling customers is going up faster than the prices we're charging those customers, that leads to a bad place. So we might ask, was it a one-off situation? Was there some anomaly during the year that caused that to happen that's unlikely to repeat? Or is it a trend that we need to develop a strategy to counter? That would be an issue. Another one that jumps out at me is selling expenses. Again, they're going up 29.9% when our sales only went up 24%. What's going on there? Why is that a trend that's going to continue? Will it be even greater next year? What's the situation there? Another way to do it is called vertical analysis. That's where you express each number as a percent of some base number in that period. In this company's case, they chose net sales as 100%, so then every number is shown as a percentage of that of net sales. So in this case, we see the increase here. Cost of goods sold is 69.6% of net sales, and the previous year it was 68.3%. So we see that worrying trend kind of in a little different way. Same thing with selling expenses. They're 12.8%. Last year they were 12.3%. This can be a really beneficial way of looking at things, especially if the volume in the business has gone up or down significantly. We can see patterns a little easier here than we can in just looking at whole numbers. The other thing we can do with this is we can take that percent column by itself, and we can then compare it to another company that we might be benchmarking against, or another agency or another entity that we're using as a benchmark to say, where are we different from them? Now, it's important that we choose an entity to compare to that we want to emulate. We wouldn't want to choose a company that's about to go out of business or something like that. We don't want to chase them down that hole. In this case here, we would see, well, maybe our cost of goods sold isn't so bad. We're actually a little bit better than our benchmark company, Madison Corporation in this case, but we clearly do have a problem with selling expenses. Not only are they going up faster than sales, but they're a much higher percentage than our benchmark company. So that's another way of looking at things. Next, the current position analysis. These are a couple of important concepts. So one, working capital, that is kind of the money that the company has to pay their bills, that sort of thing. Working capital is current assets minus current liabilities. And just a reminder, current assets are all assets that are going to get turned into cash or used up in the upcoming 12-month period. Current liabilities are all liabilities that are going to be paid in the upcoming 12-month period. So when we divide current assets by current liabilities, we'll get a ratio or a number. A general rule of thumb is that should be 2.0 or greater. So that's something to look for. That would be a key thing. If somebody were asking me to grant them 30 days credit, say I had a business and a customer came to me and said, I'd like to buy this product and I'll pay you in 30 days, I would ask to see their financial statements, and this would be the first thing that I would calculate. What is their current ratio? And if it's greater than 2.0, I would be, all things being equal, I would be comfortable granting them credit. If it was lower than that, I would require some form of deposit or a payment up front. Quick assets is a very similar, a quick ratio is a very similar kind of criteria, but it's a little bit more severe. So current assets, that's going to include cash, receivables, inventory, supplies, prepaid assets, a lot of things. Quick assets looks at just cash and receivables. So what's going to turn into cash soon? And so you'll get a lower number there, but again, it's a good indicator, probably a better indicator of what the company is going to do. So your homework for the next week, please complete that and then read the upcoming section 8.1 to 8.3, which deals with fraud in the workplace. Thank you very much.